Up next is our small cap panel, our first panel of the day, moderated by Paul Rayson of Hearts and Minds Investment Ltd. Along with our panelists, please welcome Manager Vahari Ross of Antipodes Partners, Junbei Liu of Tribeca Investment Partner, and Rob Gregory of Glenmore Asset Management.
Well, welcome everybody. Thanks for staying for our first panel session. We're very lucky to have some special guests with us today, and they're going to share their insights on listed markets in 2024. And we're also going to shine the spotlight on the small cap sector, which is long overdue for some catching up. But a big thank you to our panellists. We've just been through reporting season, and I know they've all been super busy. And I even see some companies still reporting today, even one of yours, JB. So they're laggards. So I think they should be downgraded for being late. But so context for our discussion today, and I'll put my glasses on because I'm getting old and can't see. Last year in markets, you would have done very well if you're invested in a NASDAQ ETF or something with similar exposure to US markets. If you weren't, you probably didn't do so well. But this year, given where markets are already in February, I think it's going to be much tougher. I think this year you're going to have to be a very good stock picker, which I know everybody in this room and on the screen thinks they're a very good stock picker, but I think more reliably, you're probably better off having a decent allocation to good stock pickers. And we happen to have three particularly good stock pickers up here with us today. Our panellists are going to share their reflections on last year, but also give their thoughts on what's likely to shape 2024. And always with this crowd here, stock ideas most welcome. I'm sure Steve gave a disclaimer at the top of the day, so feel free to give any stock ideas. My name's Paul Rayson. I'm CEO of Hearts and Minds Investments, and I'll be your moderator for today's conversation. So now let's meet our panellists. I'll ask each of you to give a brief introduction, then we'll move to our first question. Rob, I'll start with you.
Sure. Hi, my name's Robert Gregory, founder of Glenmore Asset Management. So that's a fund, it's got one fund, the Glenmore Australian Equities Fund, started in 2017. It's done very, very well since inception, returning about 19% per annum. And the focus is on small to mid-cap stocks, usually looking for companies that have very strong earnings growth that, in our view, isn't properly priced in by the market. Typically, we find that small to mid-cap part of the market just a better combination of earnings growth, business quality, and valuation upside. So that's Glenmore Asset Management.
And just before I leave you, Rob, just in case you missed that, Rob's delivered 19% per annum for the last 6.5 years, and it's been in the top 10 fund managers, I think, in the last couple. So pretty amazing performance. Junbei.
Junbei Liu, people call me JB. I've been a fund manager for a very long time, and I run the Tribeca Alpha Plus fund. It is a long-short fund, so some call a hedge fund, but it is just a fund where we can have full flexibility to buy across, buy or sell or short many different shares across many different classes. So whether it's small or whether it's mid or whether it's large, and I've been running the fund for almost 5 years, and the fund is just sitting just over $1.2 billion. And myself, I'm a passionate investor, and as you can see, whenever we talk about investing in the share market, I always have some sort of opinion. So that's me. Thank you.
Yeah, and $1.2 billion that Junbei runs, and also a core fund manager for Hearts and Minds. Very impressive. Vahari.
Hi everyone, I'm Vahari Ross. I'm portfolio manager at Antipodes. Antipodes is a Sydney-based global equities manager. We have $10 billion in assets that we manage on behalf of Australian clients, but increasingly clients around the world as well. We take a value approach, and we have a global long fund, global long short, and also a small to mid-cap global fund as well.
Thanks, Vahari. So let's move to our first question, which is really a recap of 2023, what happened last year. Now, the headline, if you look at the headline market returns last year, they don't really tell the story. At the headline level, 2023 was very good after a pretty poor 2022. US markets last year were up 24%. but very much skewed to a very small number of companies. The Magnificent Seven, which no doubt you've heard of, I call them the Super Six because I exclude Tesla for reasons that Steve knows. Probably no one else does. But anyway, the Magnificent Seven, they were up over 100% last year. If you exclude those 7 stocks, the US markets were actually pretty ordinary. And also, if you look at the earnings growth of the S&P 500 last year, most of it was attributable to those 7 companies, which is amazing concentration and pretty frightening, actually. Locally, the ASX was up 8% on an accumulation basis. It was up 12%. Bitcoin, which was the only bright spot in my personal portfolio, was up 155% last year, up a further 8,000 last night, which was pretty good. Last year we also saw interest rate increases slowing after increasing from 0 to about 5% in the US over the previous 18 months. So last year was a good market at the headline level, but you had to be invested in the right spot. So the first question for our panellists is, how did you go last year? I think last year took everybody by surprise, so no one would have got it totally right. But, what did you get right and what did you miss last year? I'll start with you, Rob.
Yeah, sure. Look, it was a challenging year last year. It felt for a large part of it that inflation, it was just staying persistently high. The outlook for interest rates was upward, and that just put a lot of pressure on equities, particularly small to mid caps. So it was a tricky year, a bit frustrating. We did get some relief at the end of the year with inflation data starting to moderate. But I mean, the way I approached it was just I had the companies that were in the portfolio that I was comfortable with on an earnings point of view and a valuation point of view, and I really just decided to buy and hold. I felt like it was inevitable that the inflation data would moderate given the number of interest rate hikes that had been put through by the central bank. So, it was pleasing to get some stock price reward at the end of the year where, with small caps particularly, did very well at the end of the year. In terms of what I did well last year, I mean, 2 stocks that did well, MMA Offshore, which was it's a company that services the oil and gas and offshore wind industries it owns vessels essentially that it charters out, and these vessels get used to move equipment and labour and things like that to projects offshore. It's really a cyclical company that had a huge downturn and emerged out of the downturn in good shape. Day rates have been very strong, so that's just a cyclical that was very cheap. Another one that did well was GQG Partners, which is a US fund manager. It's been a well-performed company since IPOing a few years ago. Has had good performance, was getting very good inflows, but was just out of favour last year, just with sentiment towards stocks and funds management groups being so negative. So that was another one that they did well. Did you want a bad one as well, or later on?
Quickly give us a bad one.
Okay. Yeah, I mean, a bad one last year was Retail Food Group, which is the small cap food and beverage company. It owns a few brands like Donut King, Brumby's Bakeries, Crust Pizza. And it was performing quite well operationally, but at the start of the last year, it had a capital raising that kind of took everyone by surprise. Just the size, it's sort of probably a bit bigger than I would have thought was necessary, but that kind of took the wind out of its sails. And it did also have some headwinds just in the form of consumer spending. So it had a tough year, although it has actually started to perform operationally much better. I think, I think it's well positioned still on a very cheap multiple. So, but yeah, that's one that was a frustrating one last year.
Yeah. No, thanks, Rob. I'll jump over to Vahari.
Sure. So I think one little factoid, which might be interesting, is that, yes, the Mag 7 performed that well, but the top 50 stocks also significantly outperformed. So I think there was this broader flow towards safety and liquidity in general in markets. When there's uncertainty, what do people do? It's sort of, from a human psychology perspective, probably quite expected. So I think, there was that defensive positioning that we had going into last year. Some of our defensives did quite well. Companies like Tesco and FEMSA were sort of up over the course of the year. But the end, our tech positions within the Mag 7 were the operational outperformers. But again, it was it was really disproportionate in terms of that delivery of returns. And, in terms of it was really that allocation towards defensive, the recession, the inevitable recession, that didn't actually play out. And I think that was the sort of the macroeconomic error that probably a lot of fund managers, took at the start of last year.
JB?
You put me last because I'm going to talk the most. Look, I think last year was an interesting year. So, as a fund manager, my performance is measured pretty much every minute. And every month I have a proper report card back to my client. Every quarter we'll have a review. Every year we'll have a proper full team review. So my performance is measured against my benchmark, which is ASX 200. Now, ASX 200 actually did quite well. And as Vahari said, that a lot of defensive, big quality company, they did well. And why did they do well? Because investors kind of hiding in them. Last year, you remember at the beginning of last year, 2023, there were so many uncertainties. We don't know if the inflation is going to go to double digit. We don't know if the interest rate is going to burn down the house or cause all these recession that is about to come. So there was so much uncertainty that investors didn't want to take risk. So what did they do? They piled into the things they think are safe, whether it's the supermarkets or whether it's your Transurban, things that's safe. So people hide in those names. And that the challenging part for the fund manager is that, part of my investment, I've got to sit in them because I need to do better than the market. But by just sitting in them, I won't do better than the market. So I need to beat everyone else. I've got to be earlier than everyone else. So, the things that we actually got it right is that we were a little bit early, but it did take a bit of time for market to recognize. It's going to say the retailers, as soon as we realize that, the recession is clearly out of the talk now, that we're not going to have a recession, we're having a slowdown. Interest rate path is clear, and we know it's pretty much done, or at the time was close enough to done. Inflation is stabilizing. So this is when you go to some of the company that's really been sold off. So this is when we, went straight into some of the high quality retailers, big, small, Lavisa or JB Hi-Fi, some of those names. And then we have been rewarded, quite frankly, towards the latter part of the year. It did take some time. Usually the market doesn't take that long, but because of lack of confidence from other investors, it just took that long. But so far this year, now you're seeing really that's playing out, particularly in terms of what Rob was talking about, the cyclical sectors, the sectors that has been sold off, but it is probably leveraged to the economic activity, and that is not going to be too bad here in Australia, right? We got tax cut coming middle of this year. We got immigration coming through. We got looking through our building material company. We have big exposure to building material company. All of them has been taken private, and not all of them, majority of them. We got CSR being bid for by French company. We got Boral being bid for by Seven Group. We got Adelaide Brighton was bought out. Why? We got this huge underbill coming through, and quite frankly, no one knows how we're going to solve that problem yet. So, there's a lot of opportunity coming through, and last year was a bit of a frustrating year for stock picker just because it took a little bit longer. But I think heading into this year, we're seeing everything moving the right direction. Our economy is fine. It's slowing. 2024, remember this, it's going to be marked the years. The share price will go higher, but the economic activity will go lower because we're bound to slow down with all these interest rate increases. But you know what? We have the light at the end of the tunnel. Middle of this year, we will have tax cut, we will have some stimulus support, and we will have the immigration that will support our economy. With China potentially, China is on the way back. That will provide more support to our commodities as well.
No, that's right. So it was a good, all in all, a pretty good year. But this year is going to be, as I said, much tougher. But markets have got off to a great start. Like January, February have been, November, December, January, February have been excellent, and even last night was excellent. So we're looking pretty good. But a lot of those large caps now starting to look a bit toppy. As you said, inflation's starting to slowly come down. We may get an interest rate decrease later in the year. Still some time to go. Economies are looking okay, but slowing, as you said. Employment's okay. So all indications are a soft landing, with a few exceptions like Japan, China, commodities, property. But with a few exceptions, I think it's going to be okay. And there's also a long list of risks and opportunities. So how do you think it's no one's got a crystal ball, but how do you think 2024 is going to play out, and which sectors or stocks are of interest to you? I'll go to you, Rob, again.
Yeah, look, I think it's... I'm still positive overall on equities for this year. I think interest rates will sort of be reasonably stable. Inflation seems to be moderating. In terms of sectors, a few sectors I'm looking at is lithium, which has sold off dramatically at the end of last year. And I'm really talking about the low-cost producers such as Pilbara Minerals and Mineral Resources, which has a solid exposure to lithium. I think that looks interesting. You've got some high-cost producers in lithium shutting down mines, and historically that's been a good starting point to make money from investing in a commodity when high-cost mines are being shut down. Pilbara and MinRes, their lithium mines are still profitable at current prices, so that's interesting. I mean, lithium's down 85% year to year, so it's been a huge fall, but that's a sector I think looks interesting. Coal, I think, looks quite interesting just because there's very few new coal mines or new coal supply coming on. Coking coal and thermal coal still very much in demand. And you know, some of the coal stocks are trading on very low valuation metrics. So that's a sector that I find interesting. And I think also consumer discretionary, as Junbei said, they've bounced from sort of pretty low valuation levels last year, but I still think there's a bit more to run just because consumer spending is still reasonably subdued. And I think with the fullness of time, I think we get the tax cuts, interest rates stabilising. I think people will feel more comfortable about their financial situation. So, and a lot of these stocks they've re-rated, but not back to where they can get to, as we've seen in previous cycles. So, yeah, I think there's still a lot of interesting parts to the market. Yeah.
Okay, I'm feeling more optimistic now too. Vahari, your view? You've just been on a little insights tour too, so,
yeah, so
what's your view?
I think 2024, we will see that broadening out of performance across a broader number of stocks. That, the 4,993, other businesses that are out there around the globe that we could potentially invest in. So I think, that value dispersion is high. Means there's a lot of opportunity in different parts of the market. So we're looking at, a key part of our process is really to understand those inflection points and the change in mindset around stocks. So I think, AI is going to continue to be a theme. That's not going anywhere. And I think we're definitely, looking for opportunities there, but looking for also where there might be a little bit of over-exuberance when it comes to on the short side as well. We're looking for pragmatic, value ways to play some of those themes. There's also things like the energy transition. That's something that hasn't shifted. In fact, if anything, fiscal spending is directed towards it. Regulation is changing in favour of it as well. So again, we're looking, Saint-Gobain, which is bidding for that Australian company, is a good example of a business. It's based in France that is actually directed towards. It's a building materials company that. Does injectable insulation and stuff like that, but it's trading on low multiples, single-digit multiples because of high mortgage rates. But in fact, the business trajectory is really directed towards that sustainability-based spending where, renovation rates are going to triple in Europe, as an example, because of that need to, bring sustainability to the fore. And the other element, which, the other speakers have touched on, is the opportunity in cyclicals, across the globe as well. So you've got, these are businesses that, as the economy sort of proves to be resilient and there's more, confidence about that rate cycle, you're going to get an inflection in some of those early stage cyclicals. So companies like autos, which are trading on single-digit multiples, Hyundai, Toyota, businesses like Stellantis and GM. You've also got, chemicals companies. Paper and pulp, like those types of businesses we're expecting to inflect up this year as well. And some of those happen to exist in emerging markets as well.
Okay, yep. And JB, you want to round out your thoughts for this year?
Okay, I'll be quick. So 2024, we do think the market is heading higher, but this is the year where, just by putting your money in the index or, just by the ETF, it's not going to yield you that much return. You're going to have to be very active. I do think it's active managers market this year. You got to pick the right company. And I think the return will come from, three key areas. One area is that, we talked to the bombed out sector, things like lithium. It's done very poorly. Share price halved and more than half in some cases. Just recently started showing green shoots, and we're seeing the lithium prices started moving. And some of the negative news is really, somewhat being dispelled now. So things are sort of moving the right direction. That represents a lot of opportunity. So, whether it's your Pilbara, which has got billions of dollars on the balance sheet, very strong, low-cost producer, that's probably what you look at. But there's quite a lot of names sitting in that space. You do want to be safe in these sort of sectors because, things have yet to turn in a big way, but it represents a lot of opportunity. Second bucket is that you want to go find the growth over the next 12 months, where it's going to grow. So, second bucket is housing exposure. Housing exposure come in many ways, right? Whether it's your retailers, because of tax cut and the like, and immigration, and given all these other building material companies already being bought out. So, everyone's telling you, even the corporates are telling you that there's so much opportunity coming in this space. There's money to be made. So you want to have exposure to that front. How do you gain exposure? Maybe JB Hi-Fi, people need to buy TV. And maybe it is through buying Seven Group, which now it owns Boral, once it goes through. So, so that bucket, we see a lot of opportunity and continued strong support for the years to come. And then the last bucket, I actually would say that, yes, I know the AI thematic's been incredibly strong and, feels like a bubble, looks like a bubble, and, everyone rushing to it like a bubble, but it's a real thematic. You can't ignore it. You've got to find companies that have exposure to that front. In Australia, it's a little bit harder. You've got to go down to the data center. We like the data center. You like the next DC. They just reported today. Good result, talk to strong demand. Goodman Group actually now provides a very low risk way of playing it. It's very strong. Then you filter down to the smaller names of how do you gain exposure? Maybe it's Megaport. So there's a lot of space, things that you can look into that space, and it is an area where it will yield a lot of return. It's a real thematic. You cannot ignore it. Represent opportunity, and there will be heaps of companies coming through in that space in the next many years to come. So to us, the really opportunity is really across these three buckets, and you want to have exposure to all of them. It's not enough just to buy the index because market will be volatile because US election. There's still things that in the pipeline, but the real money is made through finding the right companies.
Yeah. No, I think it will be a stock pickers market. So let's move to small caps now, and maybe call out a couple of names. Small caps have underperformed the ASX over the last 2 years by about 20%. So serious underperformance, but the cycle appears to be changing with interest rates peaking, a bit of market confidence coming back, and those small cap gems can do two things. One, they're riskier, but this crowd, of course, loves risk. But not only do they give you risk in return, they give you liquidity, which a lot of things can't. So you've got possibly an emerging cycle in small caps and the attraction of liquidity. So what do we think about small caps? Any gems or places to look? We had a disclaimer earlier today, so Rob, go for it.
Yeah, sure. So look, a few small caps that I'm positive on. I touched on it before, MMA Offshore, the stock code's MRM. That went up 80-90% last year, but it still looks really cheap. It's got a very strong outlook. There is some, there are some concerns that we're nearing the end of the cycle, but at the moment, just given that globally there's very few new vessels being built, I think the really positive conditions can continue for the next few years. It's trading on an EV to EBITDA multiple of about 4 times, so still looks very cheap. Another one I like, Universal Stores, which is a youth-focused retail company in Australia. Had its result last week, which was very good. Basically, the positive points here is it's trading on about a PE of 10 times. It's rolling out some stores. It's got good management. The highlight of the recent result was their gross margin went up a bit, which is a good effort just given the headwinds that we've got right now. And I think there's still more to run with consumer spending. I think that'll be better in 12 months' time than it is right now. There's probably two that spring to mind. Yeah.
Well, my daughter's certainly helping out with the Universal Stores share price. She's in there all the time. Vahari?
My turn. So I think one thing from a global perspective that's worth saying is, a lot of the time when Australian investors think about small caps and the riskiness attached to that, it can often be because there's, in Australia, there's a lot of mining companies, there's a lot of, early stage tech sort of companies that you're sort of hoping to make some money from. But there's literally the whole world out there. when it comes to finding small cap opportunities. And you'll find, in the small cap space, I think a lot of the ex-US market really is a small to mid cap hunting ground now, just given that skew that we've seen in markets, particularly in 2023. But, the US is more than 60% of our index now. So looking around the globe is a fruitful exercise. And it's also an area where you don't necessarily have to go down the risk curve to the same extent. So, I'm going to give you 2 emerging markets opportunities just to be different. So one is Sendas. It's a Brazilian grocer. You might think, oh, that's a bit boring. But
what was the name of that again? Say that again.
Sendas Distribuidora. That's actually growing its profits at more than 20% per annum. In the next few years, even faster than that. And there's a Brazilian consumer recovery going on. Interest rates are coming down. Core inflation is below a lot of the Western world. You've got a real inflection taking place in that stock, and it's trading on a single-digit multiple with that type of growth rate. An equivalent growth rate in a developed market, and a business with an equivalent growth rate in a developed market in that cash and carry space. Costco, as an example, in the large caps, is trading on 40 times. This is a real value opportunity in quite a defensive asset. We also have King D in the portfolio. That's a Chinese ERP database business. That's it's the Oracle SAP equivalent in China. China has a huge equity risk premium attached to it at the moment, where there's a lot of fear around that market. But this is a business that's growth trajectory is completely independent of the consumer cycle or the economic cycle that's taking place. Is a business that's more than 3/4 cloud native, and is a national champion as well, trading on, again, a trough multiple relative to its history. So that's another one. There's a lot of fruitful opportunity, outside of Australia. Australia is only 3% of world markets.
Yeah, and that's why it's important. You need an allocation to good stock pickers, because it's hard to research. Even in Australia, there's 400 companies outside the ASX 100 to the ASX 500, and there's some reasonable companies in there. They've got turnover or market cap ranging from 1.5 billion to about 100 million, and within that 400, there are some really good businesses. But how you find them is the trick, and that's why we have these wonderful stock pickers up here. JB, you might touch on that, but also, given we mentioned China, Year of the Dragon, are we at the bottom? Is there going to be breakout optimism again and stimulus?
Absolutely. It's the Year of the Dragon. Certainly what we heard from our corporates is the birth rate is on the way up. Given the marriage is picking up significantly there in China, that's a relief for A2. Look, I think China we certainly found the bottom. Bottom was somewhere, late last year, and the share price bottom was, more recently. The China is on the way up. Consumers showing confidence. They're traveling. They're spending. The recent Chinese New Year traveling, the period is now way above the pre-pandemic level now. So people are finding their confidence. They're spending. They're going around places, and some of the backlog, 12 months ago, it's all being worked through. So things are getting better, but not in a very dramatic way. So share market like to see, okay, hockey stick, things getting better. It's just going to take a bit of time, and certainly has found the bottom, and things are getting better. And it's all about time. It's all about confidence returning. I know a lot of, when things were tough for the last couple of years, there's been a lot of negativity about, the institutional investing in China and everyone's pulling money out and look, it will only take 6 months before people return, but 6 months of strong market performance before the institutional sort of interest returns. So, China is on the way up, and that's good for us, and it's good for our stock. And, for that share market, if you look at some of the valuation of what they're trading on, it's just exceptional. I've never seen anything trading at that kind of steep valuation aside from maybe like Russia or something. It is, it presents significant opportunity. We are seeing most of the strategists around the world now calling China a buy. And China economy on the way up, and still project to grow more than 6% this year. Remember, China doesn't have much of inflation, that's real growth. So, when you think about it, Chinese consumer, aside from confidence being tough and, housing market going through its challenges, they are not doing too badly. They finally had the pandemic, hard pandemic lockdown sort of reopened, they can travel, they've still got a job, and then they don't have any inflation. There's no food inflation. If anything, there's deflationary environment in some areas. They still, and they still have the money to spend, and it's really, and then they don't have that much debt. The interest rate has been going up, it's been going down, and they don't have much debt to start with. So all of that together, consumer is not in a bad place. So 6% growth real, it's significantly higher, don't forget, than us. We expected to grow real about 2% or under 2%, and we think that's great. So that's what it is. So it is an economy on the way up. I think Chinese market represent great opportunity, but to play from Australia, we have we're very intercorrelated with Chinese Fortune. We're a big trade partner. Our Treasury Wine, our A2 Fortune very much linked to that market, and they will continue to do well. Our commodities very linked to that market, and it will they should recover in some areas.
There you go, Year of the Dragon. Now, a question without notice. Sorry to do this to you guys, but the Super Six, or you can include Tesla as well, make it the Magnificent Seven. They've grown enormously in terms of market cap and share price. 3 or 4 of them are still growing earnings very strongly. Buy, hold, sell, or you can call out one of them if you like. I know it's a tough question. Vahari.
So I think the thing that they get talked about as a cohort, right? Mm-hmm. And they're not the same. They're all incredibly different businesses with incredibly different operating results that are starting to emerge now. I think it is a question of which ones of these are the right ones to own. We have investments in Meta, in Microsoft and in Amazon. They have been the operational outperformers when it comes to the most recent results that we saw in February. Apple is a business where it's certainly in our view over the last 12 months its multiple hasn't been justified by the growth. It's an incredibly innovative company. They extract blood from the stone in the sense of how much economics they extract from their users, which are tied in, which is a beautiful annuity stream. But it's no longer growing in the same way as when people were getting an iPhone for the first time, in terms of take up. So multiple not justified there. Tesla is it's down more than 20% this year. That's a business that is a car manufacturer, and as I mentioned earlier, a lot of car manufacturers trade on 5 to 10 times multiples. There's competition coming in that space. Its popularity is not the same outside of the US. I think there's a lot of, warts on that one, but again, a lot of valuation exuberance, which is, again, not our jam. I think the thing that's really interesting to think about in this sector is the concept of disruption. Technology, the nature of technology is that it disrupts itself over and over and over again. And what we're now starting to see in the big tech names is they're starting to compete with each other. So, OpenAI, ChatGPT, that's competing with Google search. It's already taken about 8% market share from Google. Google is now investing in TPUs to compete with NVIDIA's GPUs. So that range of outcomes and the margin of error, as we would call it, is actually increasing. And we need to really think about what is the appropriate multiple to pay given those dynamics are changing. So again, we don't have that investment in Alphabet. They're in a real innovator's dilemma situation. Do they have the capital? Yes. Do they have the data? Definitely yes, to succeed. But so far, that's going to require them to put a lot of capex down to sort of maybe potentially stand still. And NVIDIA, it's what a wonderful business. It's obviously done really, really well. But again, it's a range of outcomes risk for us over the next 5 years on that one.
Yeah, no, good. I feel the same way about Tesla. Well, we bought NVIDIA at 440 and I was nervous then, but look at it now. So who knows? Rob, it's not your space, but you're going to say stick to small caps, we can say sell or buy, but got a view?
Not the global equities experts like these two, but I would probably say Microsoft, just because that's the company I have the most confidence in their competitive position being maintained over the next 5-10 years. So that's probably some of the other ones. Yeah, like you can see the competitiveness dialing up, and there's still a lot of exuberance in the valuations. So yeah, Microsoft would be my pick.
Cool. JB?
Look, I always believe let your winners run. Don't get out too early. NVIDIA, cryptocurrency, let them run. Quite frankly, especially for growth company, especially very fast growth company, if they're already trading on this big multiple we're talking about to start with, what stops it from trading on squillion multiple? So especially in the environment, we know the discount rate, which is the interest rate environment outlook, is stable. There's nothing to stop them because we don't know how the growth will pay out. All we can see is that everything's going so well. It's expanding massively. This AI thematic, everyone's talking about it. It took over everything by storm. Our businesses were talking about how we can streamline things and, save costs and everything else. It is real. So, just be there, be in those companies. Same as cryptocurrency. It's become mainstream. It's got an ETF. It's got billions of dollars already within 2 months. It is mainstream. So, that's always my theme. I say, you found a winner, you stick to it.
All right, I'm getting the wind up. But final question, again without notice, a personal question. You guys manage, hundreds of millions of dollars on behalf of investors, and all they want is performance. And markets are so hard to predict day to day, week to week, year. It's tough. It's huge responsibility and pretty scary. Very quick answer, if I can. How do you manage the stress, and what do you do to relax?
Look, myself, you do spend a lot of time in front of the screen analysing companies. Try to get away from out of the desk and go for a walk in the park or bike ride. Played a lot of sport with my two boys. So, I think just getting out in the fresh air is quite good because you do spend a lot of time in front of the computer, which probably isn't incredibly healthy. But that's probably my things.
Yeah. JB, how do you stop getting up in the middle of the night looking at US markets?
I still do. Only when I'm in the US, I'm in the right time zone. No, I still do. It just become a habit now. And as a fund manager, you never really switch off. But for me, I chill and relax. I've got kids. I find this very relaxing with kids. And embarrassingly, I was just telling Paul earlier that recently I discovered Bunnings, and I've been exploring. I bought this. Someone told me that this gurney thing, and I might just spending days doing it. It's so therapeutic. But obviously, we just find ways to do things. We're human. We interact. We talk to people. Go have coffees, and just because it's part of us, and we love doing what it is, and that's just part of us.
I think that's right. I think we do this because we love it. I certainly just love looking at finding new stocks. I think that's just endlessly fascinating. It's the sort of the luckiest people in the world to get to do this job. But otherwise, I'm going to say I exercise a lot to relax, and swims in the ocean. That's my big tip.
Yeah. Good. Well, thank you guys, and it is going to be a tough year. It's going to be a stock pickers market, and you need someone who does this day to day, every day. So look at these three funds. You could do yourself a favour. So thank you for our panellists.